Oh boy, this is going to be so much fun. Why? Because we're ready to start stocks. Exciting stocks. Sexy stocks. Risky stocks. Yeah. It's a long, slow process that we're going to do, folks, because there's much to learn. It's not a sprint, it's a marathon. It's a long march. It's a long voyage for those who like to go on boats, but I get seasick in a bathtub. So let's get started on slide number 1 with a couple of observations from a humorist from the early part of the 20th century, Will Rogers. Don't gamble, take all your savings and buy some good stock and hold it till it goes up. And if it don't go up, don't buy it. Wise advice. His generation was burned more than any others with the Great Depression, where stocks lost 88%, 89% of their value. Oh my goodness. And then here's a little joke that I love. How do you make a small fortune in the stock market? Well, you start with a large fortune and make a small fortune. So, in general, as we saw with our stock mutual funds, the news is good, but there is danger involved, risk. But we're going to learn, we've already seen a little bit of how to deal with it with dollar cost averaging, and we're going to continue with that idea of thinking long term. Slide number 2. What are stocks? Well, I really don't like that term. I don't like the term stocks. It's so unfortunate. I wish we could call them businesses, because that's what you're investing in, folks. You're investing in businesses. And the real term for what we're talking about here is common stocks. Common stocks? That's another unfortunate term, because then people hear about preferred stock and they think, well, don't I want preferred stock? And no, you don't. Where did the term common stock come from? It comes from the idea that investors were shareholders in common. Every investor who had one share had one vote. If you had 10 shares, you had 10 votes, and so on and so forth. But what we know, that what we discussed in chapter 1, is that stocks represent ownership in a corporation, in a business. And stocks are often called equities because you are part owner. Equity is another fancy word for owner. It's equity financing, and enables us, the investors, to participate in the profits and growth generated by the enterprise, the business enterprise. But one thing that we don't think about often is that stockholders are limited liability owners. Well, what does that mean? It just means, look, you invest $100. You buy one share at $100 in the stock, the company goes bankrupt. And they still owe a lot of the money to the creditors, and they can't come after you. I mean, your stock is going to become worthless, but they can't come after you and say, hey, you know what, you owe us more money, because the corporation has all these debts on the books. That's not true of sole proprietorships, where you and the business are one and the same, or a partnership where they go after the partners. Now, you can imagine that certain people, one current ex-president and others, and another current ex-president, use this to their advantage, where they would create a corporation with the express purpose of putting all the debts on the corporation's balance sheet and then running away, declaring bankruptcy. So there are instances where the courts can pierce the corporate veil. And you would learn about this in an introduction to business class and business law class, so we're not going to deal with it. Just know that they can't come after you after you've lost all your money. Isn't that nice? But why do we want to invest in stocks? Well, as we said back in chapter 1, stockholders receive optional payments of earnings. They're called dividends. You can think of them like interest payments. They're not legally the same, but it's this idea. It's optional. Unlike a savings account or a bond, those are mandatory. And the thing that everyone keys on is the capital gains, the capital appreciation. The value of the corporation rises as the business grows, or capital losses. Contrary to what many people believe and how many people behave, stocks are not simply millions upon millions of worthless pieces of paper. No, it's all electronic bits now that people trade each day. They represent ownership in real businesses. Now, some of these businesses are huge, multinational, and when you buy one share, you have a tiny little piece. I like to think of FedEx as or UPS, the truck driving down the road. You have one share, and the one of the lug nuts on the left front tire. I mean, that's how much you owe. Or if you go into Walmart, you one share Walmart, there's a little shelf in the back where 1 square foot is yours. But hey, these are businesses. And what are businesses in business for? To make money. And if they do well, that means we're going to do well also. What's the historical performance of stocks? Well, over the long term of modern finance, the return from the stock market, as measured by the Standard & Poor's 500, which we've discussed and we'll get to later on in this chapter in more detail, has averaged around 10-11%. Now, as I said back in chapter 1, we try to say 8, 9, 10%, but some stocks have done a whole lot better. And in any 1 year, right, you're not going to get 8, 9, 10% or 11%. Remember the variance, the standard deviation. The return has varied from a high of almost 54% to a low of minus 43%. And 2008 was one of the worst years at minus 38.5. 2022 is about 18% down. Yeah, 18% down. Any given year, right, there's a 1 in 3, 1 in 4 chance of a down market. And we, in this chapter, there's a little document and a little discussion about bear markets. So we'll just talk about bear markets later on. They're going to come, folks. History tells us they're going to happen. We don't know. We don't know how long they're going to be, but they're going to happen. There was one major exception, and that was the great run-up from 1982 to 2000, when stocks went down. And then what happened? Right, stocks went down 3 years in a row from 2000 to 2002. So you see, you don't know. You just don't know. It's gone down, so next 3 years are going to be up. No, it doesn't work that way, right? And so, do you remember this from chapter 1? Warning, logarithmic scale. Right. Have stocks been very good to us? Yes. Stocks have been very good to us if we have a long-term perspective. And remember, logarithmic scale makes an exponential graph look like a line. So these little squiggles, they don't look very, very exciting, do they? No, they're big drops, because we're not talking about 1, 2, 3, 4. We're going 1, 10, 100, 1,000, 10,000. And so that's the logarithmic scale. And we see that stocks have literally trounced the other options. Yeah. And go back in chapter 1 if you want to see a more complete picture of how these graphs differ from one another. If we turn them into arithmetic, you can't even see the difference between bonds, treasury bills, inflation, and stocks. Right. So, is the news good? Yes. Is there a danger involved? Yes. Stocks are exciting. Stocks are risky. Well, that's not. I wish I could tell you differently, but I can't. Slide number 5. And here again is a graph that we saw back in chapter 1 that shows over 200 years of returns since the dawn of the industrial age. Stocks have just clobbered everything else, and it just makes sense. Think about how the world has changed, our standard of living, and the companies have just transformed the world in so many different ways that somebody, I like to think of one of my favorite people in the world is Beethoven. And Beethoven woke up today, he would just be astounded at what has happened to the world. Amazing, amazing. Okay, but yeah, now let's get a little bit more realistic. Now we don't have a 200-year time frame, but 10 years, yeah. And slide number 6 shows rolling 10-year periods. Now, what does this mean here, folks? Say you put $1,000 in the stock market in 1928, or 1929, or 1930. 10 years later, you didn't earn money. In fact, you lost money. But coming out of the Great Depression, you see that the stock market started to respond. And then we had World War II. But coming out of World War II, the stock market went in two directions, up and way up. So you had rolling 10-year periods where you almost made 20% on your money. And what did everybody say? Ooh, 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 is it too late to get in? Yeah, right. Right. Then come the 1960s and Vietnam and the civil rights movement and the women's rights and the gay rights and the rock and roll and the culture wars. And then we had the 1970s. And we see rolling 10-year period where you didn't lose money, but you didn't make any money. And what was the major problem in the 1970s? Well, it had to do with demographics, because economics is driven by demographics, which is a fancy word for the study of people themselves. And it turns out that the 1970s were a very difficult decade because of the baby boom generation. After World War II, it was your patriotic duty to have as many kids as you could to help beat those Ruskies. And so the baby boom generation comes of age, and they all need refrigerators and washers and they need to get jobs and housing and shoes and cars. And it was a very difficult time. And what did you hear people say here? 1973, 1974, brutal bear market, just brutal, lost almost 50%. Oh, is it too late to get out? And when you hear people say that, right, it's too late to get out. And so we come out of the 1970s with a globalization and new technologies, computerization, and then communications, revolutions, and cell phones, and the internet. And the stock market went in two directions, up and way up, and you had returns of almost 20% a year. And what did you hear people say in 2000? Blue skies, productivity gains as far as the eye can see. Ooh, 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 is it too late to get in? Oh, yeah. Sure enough, the internet bubble burst, then the housing bubble burst, and you had 2008, 9, 10, you had rolling 10-year periods where you actually lost money. You have to go back to the Great Depression to see those times. And then we call it the Great Recession. We didn't call it the Great Depression, too. And what did your people say? Ooh, 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 is it too late to get it out? Yeah, that's the time you should have been buying. You see, intellectually, we can know it. Emotionally, it ain't so easy. And sure enough, folks, here we are. We've come out of the Great Recession. Thank you very much. Pandemic, stupid microbe, COVID. But we see the rolling 10-year periods turning out pretty darn good. Now, are we going to see a return to this same hyperkinetic uppers of 20? I don't think so, but it doesn't mean I'm right, doesn't mean I'm wrong. I just don't think it's going to happen. I think it's going to probably level off more, but we'll see. We will see. That's why they call it the future. But even still, would you be happy, as we saw, returns of 8, 9, 10% over the long term? Would you be? I think I would be. I'd certainly be very happy with that. That's what I'm trying for, and I'm old. Slide number 7. Traditionally, close to half of the return from stocks was from reinvested dividends. Stockholders used to expect 4 to 6% in dividends each year. that was as much or more than bonds returned in interest, since stocks were considered much riskier than bonds. So if we go from 1936 to 2008, we see that the Standard & Poor's 500 dividend yield was 3.8%. But dividends fell to less than 2%, and of course even 1%, in the 1980s and 90s, as people were not that interested in dividends anymore. They wanted capital gains. And so if you go from 1997 to 2007, you see that the dividend was half of what it was the prior years, 1.5%. In fact, in 2000, it reached 1%. That was the height of the internet bubble in March of 2000. And of course, people give various reasons. Dividends are taxed at a higher rate than capital gains, so give me capital gains. Well, that's not true anymore. People wanted the business to reinvest the earnings for growth instead of distributing it to the investors. They wanted growth, 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 growth. Many people, there was a book that posited that stocks are nowhere near as risky as bonds. What a mistake that guy made. It was right at the top of the bubble. He called it Dow 36,000 or something like that. And that was when the Dow was, 8,000, 9,000. Stocks were no longer considered riskier than bonds. Well, that's not true, folks. We know that stocks are more risky than bonds. But we also know that stocks should, over time, do better than bonds. Do you want to eat well or do you want to sleep well? Savings accounts, which used to pay 4 or 5%, went down to 1 or 2% and then 0.01%. They're back up, as we saw when we did our little chapter 1 assignment. And of course, there's always the case that people lose track of their senses and bid up the prices because if stocks are going up, they're going to continue to go up forever, right? Isn't that how it works? No, it doesn't work that way, dear students. Stocks go up and down, and that's what we have to deal with if we're going to be investing in stocks. It's just going to happen. Slide number 8. Here is a graph that shows the return from the 10-year Treasury bond, that's in that sort of lavender purple, and then the yield from your stocks in that burnt, whatever that is, burnt red or whatever. And it turns out, if you go back to 1960, they were pretty close to one another. The 10-year Treasury bond was paying a little over 4%. And the stocks were paying about 3.8% or so, their historical average, from dividends. But then we saw the stock market do really, really well in the 1960s. The dividend yield fall to 2%. And we saw inflation start to raise its ugly head, the baby boom generation coming of age. And the yield on bonds started rising and rising and rising. The yield on stocks rose. Why? Because the price had fallen. It's a tricky little formula, but not that very difficult. You take the price divided by, the dividend divided by what? We'll do these calculations soon enough. Divided by price, and the price had fallen. So if you make the denominator smaller, it makes the quotient larger. And so because the prices had fallen so much, the dividends were looking pretty darn tasty. Of course, nobody wanted stocks in the 1970s. That's when they were going down. And then we had the peak in 1980, 1981 with inflation, and the Federal Reserve Bank, run by Paul Volcker, nominated by President Jimmy Carter. Yes, we had a president by the name of Jimmy Carter. As of this, he's still alive. And to his credit, Mr. Carter said to Mr. Volcker, you do what you have to do, which is the same thing that Biden said to the current Federal Reserve Board. Raise interest rates to kill inflation. And it worked. The inflation started falling, and the yield on bonds started falling, and stocks started to do what stocks do when things get better. Go in two directions, up and way up, and finally, until the internet bubble, at the top of the internet bubble, the yield on stocks was down to 1%. Notice the yield on bonds keeps falling and falling and falling. And then we had the Great Recession, where the yield on bonds went below the yield on stocks. Folks, when that happens, unless the world ends, that's usually a pretty good sign for stocks. And so far, since then, notwithstanding the COVID 2020 and then 2022, it's been a very good time for stocks. And sure enough, we saw that happen a few times. The flirting with the bond yield going below the stock yield, and stocks doing pretty darn well. And then 2022 comes along, and the bond yield comes back up to close to 4%, which is where it was back in 1960. So there are those who are saying, yeah, but we should also see the stock yield go back up. Well, that's they might be right. They might be right. They might be waiting for people to say, you know what, I want to see more dividends before I'll continue to invest in stocks. I don't know if that's going to happen, folks. People are pretty darn. I'm a big dividend fan. In fact, I'm gonna, as we continue on our marathon here with regard to stocks, you're going to see that I love dividends. Dividends don't lie. But others are, no. I want growth. Forget the dividends. So we'll see what happens. But certainly, when we get to bonds later on, we'll see that bonds are paying a lot better than they were since the Great Recession, where bonds were paying very little money in terms of yield. So the pendulum swings. The bear market of 2000 to 2002 and then 2008 changed many investors' perceptions about dividends, not all. We now see investors and companies focusing more and more attention on dividends. Many companies that never paid dividends in the past are doing so now because they're no longer growth stocks. They're mature industries. And the perfect example of this was Microsoft in 2003. They had cash coming out of their ears, right? How many times can they rewrite Word? Every time they do it, they make it worst. That's why I call it Microsoft Worst or Windows. So finally they said, okay, we're going to pay dividends. And then for a while there, before the price recently has done very, very well. Before that, the price they were paying a very healthy dividend, but now the price is a lot up. So the dividend's still not bad, but it's not what it was about 8 years ago or so. Also, the tax law has changed so that dividends are taxed roughly the same as capital gains. This has been a big advantage to certainly very wealthy investors and all investors. I love this line. I wish I had made it up. Dividends don't lie. It was a book written by Geraldine Weiss, who was based here in San Diego, La Jolla, actually. The book's not very good, but that is so true. Dividends don't lie. Do you know the only thing that gives me pleasure? It's to see my dividends coming in. Now, this is attributed to John D. Rockefeller, he of the Standard Oil, which is now Exxon. We don't really know if he said it or not. His neighbor said that's what he said. Okay, whatever. But folks, we're going to go through. You're going to look in this chapter. You're going to look up some statistics, earnings per share, market capitalization, dividend yield. You're going to look up these things. But you know what? The only number that you know is right and is true is the dividend. And why is that? Because they wrote you a check. Well, they don't write checks anymore. It's all electronic. But still, that's the number you know is correct because it's money in your pocket. And when we get to further chapters, we're going to see lots more numbers. And all that could be total borscht. Enron, WorldCom, Global Crossing, lots of not that many really when you think of there are thousands of companies, but there are frauds out there, folks. And so dividends don't lie. Slide number 10. Now, you've probably heard the terms bull market and bear market, but we just want to make sure, we want to put it here in writing and make sure you study it because you should know what a bull market is. That's when prices are going up and people are happy, investors are optimistic, economic recovery, government stimulus and the like. Whereas bear markets are markets that go down. Typically, it depends on who you talk to, but most likely, the people you're talking with are going to say, yeah, 20% down, that's a bear market. We have a little presentation on bear market, history of bear markets that we'll talk about later on, but it's in there in chapter 3, so you're going to see that. Where did the terms come from? Well, for those of you who are interested in this kind of thing, do look it up, because there's the typical explanation, and then there's the real explanation. And I don't really understand the real explanation. Don't sell the bear skin before the bear is caught. Can't figure that one out. But anyway, there's a little link to Investopedia's take on the origins. Most people will tell you bulls charge ahead. They throw their opponents up in the air, right? So that's up in the air. Whereas bears are more reclusive. They when they do attack, they use their paws to knock down their opponent. That's not the real reason that's called, but it's not important. Just know bull market, charging ahead, bear market down. Are we in a bull or a bear market now? Well, again, it depends on who you talk to. We've been, in my humble opinion, the one measure I follow, we've been in a bear market since the beginning of 2022. We've gone down more than 20-some%, actually. I forget exactly the amount. But we haven't come back to where we were back in early 2022. But others say, oh, no, we've hit a bottom and we've come up 20% from that bottom, so we're now in a bull market. It's up to you. You decide. But I use the first definition, where you have to wait until you get back to where the peak that you were. Remembering that these indices that we use change all the time, so it's not a perfect measure to begin with. So do take a look. It would be a good idea to take a look at Investopedia's take and other people's. See what other people say about what is the definition of a bull market, bear market, where do the terms come from? Yeah. Slide number 11. So let's take a little stock now. Ha ha ha, pun intended. Let's take a little a pause and say, what are the reasons? Why do we own stock? What are the disadvantages? What are the cons? What are the advantages? What are the disadvantages? Because all investments have advantages and all investments have disadvantages. Don't let anybody tell you differently. The advantages, the pros, are that they allow the general public to share in the rewards of the business enterprise. Hey, you use Nike shoes, right? You could be part owner of the company that you buy your shoes from. They have been the best financial investment returns over time from capital gains and dividends, and the real estate agents jump up and down and say, well, real estate's done better. Well, maybe not here. Yeah, in San Diego, but it's a different world, and we'll get to real estate way at the end. It's a whole different world. Easy to buy and sell, very liquid, assuming you're buying real companies, bona fide companies, and there are phony companies that we'll see. Penny stocks are called. But assuming you're buying companies that most people know of, and maybe some haven't heard of, but they're real companies, earnings and the like, they're easy to sell and easy to buy. We talked about the limited liability, assuming, again, that you're not trying to pull a fast one. The corporation is bankrupt. Well, that's too bad. They can't come after you for more money. And the one thing that we've impressed upon you is that this system is not perfect, but it's a whole lot better than all the others. What's the saying? Capitalism might be the absolute worst economic system out there, except for all the others. We have seen our standard of living increase exponentially, along with our investment returns from stocks, such that somebody waking up after 50 years or 200 years or 100 years could not imagine what we... And again, I've told you before, and I will tell you again, I'm assuming we don't blow ourselves up, die in our own waste, meteorite, tsunami, whatever. I'm firmly convinced that the next 20, 30, 50 years are going to be even better. We'll see. What's the cons? What's the disadvantages? Well, as we've said, you're going to lose some money. You might lose a lot of money depending on what kind of stocks you buy. They're risky. They're volatile. If someone says, you say, how was that stock? Well, it's been volatile. That means they bought it for $11.88 and sold it for 30 cents. Do you know anybody who's bought a stock for $11.88 and sold it for 30 cents? I do. I've known him all my life. He's kind of a goofy guy, teaches at Southwest. It was a really good company, folks. It was based here in San Diego, Alliance Pharmaceutical. They were going to make artificial blood, and because, hey, the blood banks are always screaming for more people to come and donate blood, right? And if you have artificial blood, you don't even have to, that all goes away. You don't have to test it for HIV or hepatitis B or, yeah, it didn't work. And so the blood banks are still asking for people to come and donate blood. And that's, that's when I I was the sucker for these biotech companies, which are going to change the world. I mean, it hasn't quite happened yet. It's happening. We're going to cure cancer. We're going to do all kinds of wonderful things with biotechnology. We'll think about what they did with the COVID virus. I'm firmly convinced, and we'll see, that the biotech world is going to change the world more than the computer world, more than the cell phone world. I'm firmly convinced of that. It hasn't happened yet, but it will, I think. We'll see, because once you start getting down at the genes level and the DNA level and start turning things on and off, oh boy, the possibilities are just endless. I mean, really, the big one is they're going to cure cancer. We're going to cure cancer. It's happening. It's happening. Look up CAR-T, C-A-R-T technology. I forget exactly what it stands for, but they literally take your blood, take your T cells, your killer T cells, leukocytes they're called, I forget. They take them out of your body, teach them, change the genetics, teach them that the tumor that you have is not part of your body, because cancer is pretty tricky. It says, hey, we're part of the body, don't kill us. And your immune system says, well, CAR-T technology trains your immune systems to say, no, that guy's the baddie. They put the stuff back in you, you get the worst cold symptoms you've ever had in your life, because that's the symptoms that you get when you have a cold. It's not the cold, it's the immune system, your immune system waking up and going, oh my God, we got something to do. We got to do this. We got to fix this quickly. And so you have the worst cold you ever had for 2 weeks, and then the tumor's gone. It's happening. It's happening, folks. So I'm really excited. And then, of course, corporate financial industry hanky-panky. Oh yeah. There's people out there who are ready to steal your money in the name of stocks, and so we'll see some of those scams. We already saw one. We'll see others where companies are not real companies. They're just somebody's garage somewhere in Iowa or Idaho, one of those places that starts with the letter I. And yeah, sure, the stock's going to go from 0.2 cents to 20 cents in just a few weeks, so get in now. So there are advantages to stock ownership and there are disadvantages to stock ownership. And you should, really study these, because you're going to be the financial guru for your friends and family. So you have to acknowledge, stocks aren't perfect. Here are some of the advantages, but here are some of the disadvantages. And if we, think carefully, do our homework, keep our eyes wide open, we should do okay. Yeah, no guarantees. Slide number 12. Volatility examined. This is why, folks, you don't want to try to be a trader. You just don't want to be a speculator. You want to be a long-term investor. Because here, at the beginning of 2022, there was a lot of optimism. The end of the pandemic was in sight. The country had survived an insurrection. And the stock market did pretty darn well in 2021. And then what happened? We come out of the gates, you put in your $10,000, and then the market then drops 10%, maybe even a little bit more. And what do you say? Is it too late to get out? So you pull your money out, then the market jumps back up about 10%. And what do? Okay, I'll put it back in. And then, this is what it is. If you tried it, You try to figure it out what's going to happen in the next few weeks, next few months. All I can say is good luck. And then you put your money back in, and then it falls back again, and then it goes back up again, and you trade because this guy on the internet showed you how that these are the technical indicators that you're going to use to buy. And then at the end of the year, it's October, and you say, never again. I'm never going to put another dime in the stock market again. And it goes up another 10%, and then falls. And hopefully you just put it in and left it in. And if you did, you lost about 20%. Oh, yeah. But so far this year, it's come back a little bit. Now, what's going to happen next year? I don't know. The year after that? I don't know. But assuming, again, we don't die in our own waste, nuclear holocaust, earthquake that destroys, all of California or all of Europe or whatever, all of Asia, or a meteorite or another pandemic that's even worse, or disco returning, which I know you think that's funny, but you didn't live through it, folks. I'm firmly convinced the next 20, 30 years are going to be better. We'll see. Okay, so now, and we'll come back to this volatility idea, folks. We're going to learn how to make volatility our friend, or at least our traveling companion, and we can later on we can kick him off the side of the road. So go back over this in material. Study hard, bring honor and glory to Southwestern Community College, because this is important stuff, folks. And you are going to be the investment guru for your friends and family and coworkers, and we are so proud of you. Okay, because in our next presentation, we're going to take a look at stock markets. How does this thing work? What's actually going on? Well, it's mostly invisible to us, but we'll see what's actually hiding behind your screen when you buy 10 shares of Home Depot. Cool. Thank you so much for being in our class. We are so proud of you. Be awesome, dear students.